The Relationship Between the CMO and the Corporate Finance Function by Lisa Rittenhouse. Chief Marketing Officer and 4 types of business. A Chief Marketing Officer will participate in making complex finance decisions. 4 different types of firms a CMO will experience during his career is a sole proprietorship. This type of business is operated and owned by one person. The other is a limited liability company. All the owners can run the business and they have a limited liability. Corporations. Corporations is separate from its owners and functions as an artificial, legally defined being. Corporation can enter in contracts, purchase assets, and incur obligations. Ownership of a corporation is represented by shares of stock, and the owners are called stockholders. And the last type of business is partnership. Partnership is a business operated and owned by more than one owner. Finance managers and financial institutions. The goal of the finance manager is to maximize the wealth of the stockholders. Financial institutions provide such services as taking deposits, managing investments, brokering financial transactions, and making loans. The CFO is responsible for making complex financial decisions. The CMO may participate in decision-making process and deciding which projects to invest in to advance the marketing department. The CFO and the CMO works very closely together and requires a good working relationship. Net present value. Net present value, which is known as NPV, of a capital budgeting project indicates the expected impact of the project on the value of the firm. NPV decision rule specifies that all independent projects with a positive NPV should be accepted. NPV projects with a positive NPV are expected to increase the value of the firm. If they are greater than or equal to 0, then you accept the investment. If not, then you would reject the investment. Payback decision rule. Payback decision rule is an investment rule, states that a project has to pay back its initial investment within a specified period of time to be accepted. The time frame is specified in advance. The payback period is the amount of time it takes for the cash flows from the project to equal the initial investment. If the payback period is within the time frame period, then the project should be accepted. Internal rate of return rule. Internal rate of return rule is a metric used in capital budgeting, which measures profitability and potential investments. IRR is a discount rate which makes the net present value equal 0. IRR calculations rely on the same formula as the NPV. Below is the equation that would be used. How to choose between projects. This is how the CMO would decide on whether or not to accept or reject a project. Managers have to decide on whether to accept or decline a project. Projects often compete with one another, and when this happens, they are referred to as mutually exclusive. Differences in scale could be one reason. An IRR doesn't compare projects with differences in scale. NPV should be used to calculate if the NPV is positive. Timing of cash flow. Projects with different timing cash flows can be determined by using the NPV formula to determine if the project has a positive NPV. Projects with different lives. When projects have different lives, computing the equivalent annual annuity can help you decide whether or not this would be a project that you would want to invest in. Limited resources. When resources are limited, not always choosing a high NPV is correct. In some situations, knowing the profitability index is insightful. which measures the NPV per unit of resource consumed. Ethics on decision making. Below are 4 ways to prevent poor ethical decision making. Recognizing common characteristics of poor decision makings. Not being overly confident would be one. Not understanding the complexity of issues could be another situation that you could then choose unethically. Higher corporate structures are weak or non-existent. We are only as good as our leaders. Learn ways to resist requests to act unethically. Recognize when requests are unethical. Knowing your company's employee manual and ethics guidelines. If you notice something that's unethical, then be prepared to report the incident to HR. Understand ways to lead to ethically. Always act ethically. That's very general, but we need to do what is right. Communicate company's core values, code of ethics, and guiding beliefs. Punish unethical behavior with appropriate consequences. Bible on being a good steward. Titus 1:7-9. Since an overseer manages God's household, he must be blameless, not overbearing, not quick-tempered, not given to drunkenness, not violent, not pursuing dishonest gain. Rather, he must be hospitable, one who loves what is good, who is self-controlled, upright, holy, and disciplined. He must hold firmly to the trustworthy message as it has been taught, so that he can encourage others by sound doctrine and refute those who oppose it. Whether it's in our personal life or professional calling, we are supposed to be good stewards with our money and our possessions, because everything we ultimately have belongs to God. If we are being irresponsible with our money and not making good decisions, then we are not bringing glory to God. We need to take the time to calculate and weigh the pros and cons to make the right decisions, so everyone, including God, can prosper. This concludes my presentation. The next 3 slides are my references used.